In this video, we're just going to cover a few of the problems that were presented in the PowerPoint presentation for the lecture. So we're going to talk a little bit about taxes, we'll talk about the stock market, and we'll talk about how we might look at changes in revenue for a company. So as we go through here, here we have a company that had $10 of earnings per share before taxes, and it's going to distribute all of its net income as a dividend. So the corporation pays 21% on its taxes, and the individual tax rate on dividend income is 15%. So let's look at how this might impact a company relative to whether it's a corporation or whether it's maybe a sole proprietorship or maybe an S corp. So corporation pays taxes on $10. 21% of that is $2.10. Of course, that leaves $7.90 to distribute. Again, the individual has to pay 15% on that. So 15% of that is $1.19. That leaves $6.76 to the shareholder after all the taxes are paid. So as a shareholder, I use the word only here, even though it shouldn't be the word only. The shareholder pays $3.29 in taxes. So this is a total effective tax rate of 32.9%. If you look at a sole proprietorship, let's assume that the owner pays 25% on its income. So on the $10 earned, they'd pay $2.50 in taxes. Definitely less than the $3.29. And in this case, $2.50 divided by the $10 means that the sole proprietor's individual tax rate, the effective tax rate, is 25%. So let's look a little bit more deeper in this, right? Here we have a company that has earnings before taxes of $800,000 and a tax rate of 21%. What is the tax that needs to be paid to the shareholder? If you calculate the tax, 21% of $800,000 is $168,000. So what's the net income? If you subtract $168,000 from $800,000, that is $632,000. If all that income is distributed, what is the tax that individual shareholders will pay? And that answer is $94.8 million, or $94,800. So what's the remaining income? The shareholder ultimately would have $537,200 would be left over for the individual shareholder. If they were a sole proprietorship and the tax rate were 20%, right? What is the net income? Well, the tax is 20% of $800,000 or $160,000. So the net income is $640,000. So you can see the net income, the amount of money going to the owners of a sole proprietorship is more than the amount of money that goes to the corporation. So what is the effective earnings? If you take the $632,000 and divide it by $800,000, then the earnings, the actual take-home income from the corporation is 67.15%. That is just 632 divided by 800,000. If you take the 640 divided by 800,000, that number is 80%. So the final question then, what is the effective tax rate? Well, it's 1 minus this amount, or you can take the tax divided by the income. So the corporate tax that's ultimately paid by the shareholders is 32.85, and the tax paid by the sole proprietorships is 20%. So you can see that there is a big difference, right? The tax rate that corporations are imposed, quite frankly, is not that much different than the individual. However, the concept of double taxation really looks at how much money do the owners ultimately get to spend from their earnings. So I downloaded this from Yahoo Finance, and it's on Molson Coors. On this day, Molson Coors was selling for $72.50. It was up a penny since the day before. But let's look at excuse me, some of the statistics, right? There is a concept of something called the bid-ask spread. If you subtract the bid from the ask, that's the bid-ask spread. This is the profit per share that goes to the brokerage house for selling this security. Now, that doesn't include the commission, but in this case, essentially, it's about 2 cents, right? $7.7263 minus $72.61, about 2 cents. On this day, the volume, there were 429,742 shares that were traded on this day. So if you take 429,742, multiply that by 2 cents, essentially the brokerage house on this day made $8,594 from these trades. Again, that doesn't include the trades for, or the commissions that actually go to the salesperson, the broker. This goes to the brokerage firm. On an average day, again, 1,938,196. That's the average number of shares that trade per day. If that would have been today, it would have been roughly $38,000 was made today on those trades. So let's ask some other questions, right? On average, if you look at this, we would say that on this day it appears that the trading was very light. There wasn't a lot of activity relative to the average on this share. So what's market capitalization mean? This company has a market wealth of $15.663 billion. If you take this stock price and multiply it by the number of shares outstanding, that's what the entire company would cost to buy all of its stock. Next, does the company pay a dividend? If you want to know if the company is in the dividend business, you look down here and there's always information here. If the company did not pay a dividend, this would say NA. In this case, looking forward, right, this company pays a dividend, and this is an annual dividend of roughly $1.64. So this is what they expect to pay. Earnings per share are $6.53. Dividend is $1.64. The dividend yield is this 2.28%. So if you take $1.64 and divide it by $72.50, essentially in this next year, if you bought the stock today and this dividend occurred, you'd earn roughly 2.28% just on the dividend. So what is the yield? That's this return. What is the payout ratio? If you divide the dividend, $1.64 divided by $6.53, that represents the percentage of money paid out to shareholders. In this case, it was roughly 25%. Again, there was lots of information. We see here that a 1-year target, they're estimating that 1 year from today, this stock will have a target price of $89.19. So if you take $89.19, and if you divide that by today's price of $72.50, that is roughly 23%. So you have 23% is what the expected increase in return from capital gains is. If you add that to the dividend yield of 2.28%, if you bought this stock in 1 year, the estimate is that you would earn roughly about 25.3%. So how is this stock stacking up? Well, 72, the lowest price over the last 52 weeks is $70. $72 is not that far above the low end here. So it's been as high as $97.50, but currently it's pretty close to the bottom. So they're expecting, if you believe the numbers we see here, that the income is going to grow rapidly over the next year. So hopefully we'll be able to look at some of the things that affect these numbers so we can kind of understand something about stocks and stock prices. So the next thing we want to do is look at what is the impact of depreciation, these non-cash expenses. What is the impact on cash flow and on profits? So if you had an $80 million depreciation expense, what is the global tax rate on that? Let's just say it's 21% is the new corporate tax rate. How would that impact expenses? And then how would that impact the cash flow of the company? So depreciation is an operation expense. So it's going to affect operating income, earnings before interest and taxes, and pre-tax income. They would all fall by $80 million. This would decrease pre-tax income, right, and would reduce the tax bill. The tax bill would go down by 21% of 81 million, which is the tax bill would go down by 16.8 million. Therefore, net income is going to fall by 63.2 million. On the income statement, on the statement of cash flows, net income again falls by this 63.2, but we need to add back the 80 million of non-cash expense, so that cash from operating activities would actually increase by 16.8 million. So the cash of the company increases by the size of the tax reduction from the expense. So you can see that being able to deduct anything from operating income flows back into the cash flows of the company. So the last thing we want to look at is just want to look, I gathered this information from Disney, and Disney reports its segment revenues. So in 2017, this is in millions, Disney from their media networks had $23.51 million in revenue. In 2016, it was $23.68 million. So to calculate growth, you take the ending value, divide by the beginning value, and then subtract 1. That gives you the decimal form, obviously multiplied by 100. Then in this case, media networks lost 0.717% in revenue. Parks and resorts were up by 8.54%. Studio entertainment was down by 11.2%. Consumer products and interactive media was down by 12.5%. So on total, The total sales revenue this year, or 2017, was 55.14, and in 2016 it was 55.61. So that accounts for a total of a negative 0.845% reduction in sales revenue for Disney. To find out a forecast, what do we think is going to happen next year, if we assume that next year is the same as last year, if you multiply 55.14 times negative 0.845%, that ends up being that we would estimate that next year's revenue for Disney would be 54.67%. Again, breaking down by segment is kind of enlightening when you think about the overall company. Now, even though we have these huge losses in these areas, those companies, those segments have relatively low value, low revenue, if you will, with respect to the rest of the company. On the other hand, we have this 23 million. We actually lost on media networks on the biggest component. We actually lost revenue in that area. So again, what Disney would like to do, obviously, is find out what's going on in these areas, but increasing these areas by 1 million or by 1, right, either, although it would reduce this negative, it's not going to have a tremendous impact on the total revenue of the company. They need to focus on trying to figure out how to grow this major segment of the company. Increasing this by 1 million will substantially increase the overall value of the company and the growth perspectives moving forward. So again, we're going to talk about analyzing a company, right? So these are all the things that are important when you think about what's going on inside a company. We have to recognize something happens to revenue, something happens to the ratios within inside the company. It's a very complicated process, analyzing what we think a company is going to do moving forward.